Welcome to what I believe is the most important part of day trading, and that's risk management. Risk management involves analyzing the probability that a certain event will occur, and then controlling the impact that that event could have depending on various outcomes. And this is really at the core what professional day trading is about, using statistical data to determine the probability of how price might behave. And then based on that probability, we can make more informed and calculated decisions to control how the potential outcomes will affect our trading account. Before you take any trade, you need to ask yourself a few very important questions. Which direction is the price more likely to go in? And if you were to enter into that trade, what is the probability that the price will hit your target before hitting your stop loss? And then you need to analyze the effect that each scenario would cause. If the price were to hit your target, how will that affect your account? If the price hits your stop loss, how will that affect your account? And the answers to these questions can help guide you in making the right decisions from not only making profitable trades, but also protecting yourself from the times when you take unprofitable trades. Because the reality of trading is that it can be unpredictable and random at times. As much as I would love to tell you that there are ways to predict the market with 100% accuracy and never take a losing trade, the reality is you won't. Taking losses is just part of this business, and no trader is immune to them. And let me show you why. I want to tell you about a story I read inside of a book called Trading in the Zone by Mark Douglas. This is one of my favorite trading psychology books, and I highly recommend you read it if you haven't already. But there's this part in there where the author is talking about how this hotshot trader was explaining to the CEO of some high-level brokerage firm how he could use charting analysis to predict the outcome of price movement. So together, they pulled up the chart of the soybean market, and this hotshot trader was mapping out support and resistance levels and said, if the price comes down into the support area, it's going to stop dropping and reverse upwards because the price is at a strong support level. So as they were watching the price of soybeans come closer to the support level that he had mapped out, the CEO asked the hotshot trader if the price was going to stop dropping and go up from here now that the price is at support. And the hotshot trader says, yes, absolutely. The CEO says, okay, well, watch this. He picks up the phone and says to the person on the other line, sell 2 million units of soybeans at market. And then right then and there, the price fell through support and kept dropping. The CEO turns to the trader and says, see, if I can do that, anybody can. The point of that story that the author is trying to convey is that at any given point in time, some unknown and uncontrollable factor can swoop in and ruin your prediction, and it would be impossible to see coming. And this is why the market has a little bit of randomness to it that makes it impossible to predict what the price will do 100% of the time. But just because we can't be right all the time doesn't mean we can't consistently be profitable. In the next lesson, I want to show you one of the most successful business models in the world that makes its money purely off the game of chance, and how you can implement the same types of strategies in your own trading to be successful as well. I hope you all learned something, and I'd like to thank you so much for watching.